Well, market recovers after a weak start. The Nifty is back above 17,380 after breaking the budget day low of 17,350. Financials buck the trend with the Nifty Bank up almost 1%.
Bajaj Auto skids into red as reports indicate the company has cut production by 25% across its export plants given weakness in markets like Nigeria. The company tells CNBC-TV18 it has been lower for all two-wheeler exporters in the past few months.
And Paytm gains. Sources tell CNBC-TV18 that Bharti Group was in talks with the company for a stake buy, but the deal fell through as Paytm management declined to give up management control. The company says it is focused on its organic growth journey.
Consumer companies strike a confident note. Indian Hotels tell CNBC-TV18 that post-COVID recovery is driven by higher prices and therefore more profitable. Berger expects double-digit volume growth in FY24. VIP tells us that growth is 20% higher than pre-COVID levels seen in FY20, while luxury watch retailer Ethos cites strong demand while guiding for 25% growth in FY24.
And Dr. Reddy's announces the acquisition of Main Pharma's US generic prescription product portfolio for $105 million. The portfolio includes 85 generic products, many of which are focused on women's health. The stock trades down 2.5%.
Hello and welcome to Halftime Report. I'm Ekta Batra. With me is Sonia Shenoy as well as Manglam Malu. Well, it's turning out to be a session where we are seeing some amount of resilience at least coming through for the markets, especially for the financials. We have the Nifty, which is bounced off the lows of around 70,300 on an intraday basis. But for the Bank Nifty, it is up around 0.7%. We've regained levels of above 40,200 for the Bank Nifty. Let's see whether this kind of outperformance and resilience maintains. It is a day of a lot of stock-specific action. Bajaj Auto, Adani stocks, Paytm, to name a few, and even SpiceJet, which has moved to the high point of the day, up around 5% after that board meet outcome. Hi, guys.
Hi. So, I was looking at... Go ahead.
It is actually SpiceJet that's up almost 5% right now, as you said. I was just reading the details of the board meeting, and they have gone ahead and approved the slump sale of their cargo business. So that's the reason why, the stock is up and about. This was something that was in the making for a while, but they're saying that the transfer of the cargo business shall be done for an amount of 2,555 odd crores. And as part of the ongoing restructuring with aircraft lessor Carlyle Aviation Partners, all the CCDs will be transferred to those aircraft lessors who agree to exchange their lease liability for an aggregate amount equivalent to the total nominal value of the CCD. So a lot of, announcements have come through, but I think the slump sale of the cargo business is one. Second is there's a debt equity swap with aircraft lessor Carlyle Aviation Partners, and there's a settlement with the aircraft lessor Castle Lake as well. They will be raising funds through the QIP route. So all of that put together, these are just, the prima facie statements that have come out from the exchange notice. But all of that put together is what's causing the stock to surge.
All right, that's about SpiceJet up around 5% as we speak. One of the few, mid-caps which is gaining in today's trading session because the broader market currently continues to reel under some pressure. Even as the, frontline indices have recovered thanks to the recovery in Nifty Bank, we still have around 4 stocks declining for every stock which is advancing. So let's talk about some of these decliners itself. Sonia, we did speak about Bajaj Auto at the top of the show. In fact, we marked it as an important headline of the day. They've cut production.
They have. This is not something new, but it is definitely a concern. So Bajaj Auto has, according to reports, taken a 25% production cut, especially in its export business. That's because of the ongoing challenges that we are facing in markets like Nigeria. The company is likely to produce around 250 to 270,000 units compared to an average of 338,000 unit production in 9 months of the year. Now, I reached out to the management. They said that this export production has been lower across the board, not just for Bajaj Auto, and it's been happening for the last many months. So it's nothing new in that context. But remember, the numbers will be coming out, the sales numbers for the month of February. And the expectation is that it will not look very good. So Nomura put out a note where they said that the export wholesale numbers for Bajaj Auto are expected to fall 45% in the month of February to 112,000 units. And overall, the two-wheeler volumes are still going to be down for 30% for the industry from the peak that we saw in June of 2018. So negative news coming in there, and of course cutting the production is not looking good at all.
Absolutely. Well, the numbers should be out on the 1st, which is on Wednesday, in terms of the auto sales for the month of Feb. That's Bajaj Auto down around 5% odd. Sonia, thanks very much for that. But let's move on to the big story that we're tracking today. Sources tell CNBC-TV18 that Bharti Group was in fact in talks with Paytm for a stake buy, but the deal fell through as Paytm management declined to give up management control. Nisha Podar is here with clarity on what exactly transpired between the two parties. Nisha.
Thanks so much. Yes, I have been speaking to a whole host of my sources who are directly involved in the two companies and who have a direct knowledge on the deal developments. What I have gathered over the weekend is that Bharti Group did reach out to Paytm to look at an exploratory talk of buying stake in the parent company, Paytm, even though the interest has been on Payments Bank, but it was the parent company, Paytm, that they had been interested in buying a stake in. But those deal talks have collapsed. There is no talk at the moment on any particular transaction between Bharti Group as well as Paytm, is what we gather from sources with direct knowledge. In terms of the reasons why no such transaction or deal talks really continued is because, first of all, Paytm management is clear that they want to grow the business organically and they are not looking at any strategic sale of stake or passing on of the management control. And that was something that Bharti Group had explored in terms of their talks with the company. And on the other hand, Paytm also doesn't feel that there is a strategic alliance between Bharti Group's Paytm Bank as well as theirs, because the business model, even though they are in the same space, are very different from each other. So those are the reasons. But also remember, there has been a lot of speculation on Ant Group as well as SoftBank looking at selling down their stake. Well, Ant Group will have to pare down a little bit of in the company because of the SEBI norms, which does not allow it to touch the 25% trigger limit. So they will have to sell some stake there. But also experts do point out that Ant Group as well as SoftBank put together have about 38% stake in the company, and any deal talks will need their approval, and also they will play a pivotal role in any transaction at Paytm even in the future. But Paytm did say that they are looking at focusing on the strength of the company with organic growth, and Bharti Enterprises said no comments on market speculation.
All right, Nisha, thanks a lot for that. So that's about Paytm and Airtel, whether there would be a merger or not. Nisha, clarifying on the latest out there. Take a short break, come back, get you more on the markets as well as we get chatting with the management.
Talk on our radar right now. It was a good quarter for the company in Q3, healthy revenue and EBITDA growth. But let's find out what this year, this calendar year will look like. Ajit Kumar Rai, the founder and chairman of Suprajit Engineering, joins us now. Mr. Rai, good morning. Many questions, but first up, if you can tell us what's the outlook for FY24? Because, you know, in 9 months of this year, your revenues have gone up 50%. You're sitting on a base of around 2,000 odd crores. What is the kind of scalability that you see for Suprajit Engineering in FY24?
You know, our guidance have always been, good afternoon, first of all, thank you for having me on your channel. We always guided that we will outperform Indian automotive industry. And in this first 9 months, as you have seen, against the industry growth of just about 15%. On a standalone basis itself, we have grown by 20%, whereas on a consolidated basis, we have grown nearly by, 55%. So I think our guidance is in line with our past, that we'll outperform Indian automotive industry by anywhere from 5, 10, 15%. And for the balanced quarter, we again will have a very strong quarter. As you rightly said, Q3 have been a very good quarter for us, where EBITDA margins improved in Phoenix Lamps division, which was for the first time into double digit. LDC turned the corner with an EBITDA positive quarter. And our standalone domestic cable divisions have done phenomenally well. So we have had a good quarter and also 9 months. And I think next year, despite the global trend, it's important to note here that nearly 55% of our business is outside of India. Despite the global pressures in terms of economic slowdown, interest rate hikes, and automotive business itself is slowing down, we still continue to have a very strong pipeline of orders. New business have been won. So we look forward to a very good year for the coming year as well.
All right. Mr. Ajit Kumar, I just wanted to know on a couple of specific divisions of yours. The LDC division, it turned operationally profitable this time. For the year, you had a guidance of what, $85 to $90 million. Next year, around $100 million plus in terms of revenue. Do you maintain that? And your targeted margin band of 14 to 16%, by when do you get there?
I think on the LDC, I think at the beginning of the year when we first acquired, we have given a guidance that we'll do, I think, about 85, 90 million this year. That holds good. And I think our target for next year is 100 million. That also holds very much good. On a consolidated basis, I think we have historically guided that we will be in the EBITDA margin range of 14 to 15%. In the first 9 months, I mean, excluding LDC, of course, it's the new division, we are well within that 14, I think 14.5 or 14.8% EBITDA margin. So the margin guidance as well holds good, excluding LDC, of course.
Okay. Mr. Rai, welcome to the show. You're sounding quite resilient about the company, but I wanted more perspective from an industry standpoint. What might you be witnessing, both in the export market as well as in the domestic market, especially when it comes to factors such as rural stress? And the context of this question is this morning, for example, Bajaj Auto is cutting back its production as per reports because of some amount of chinks in the armor when it comes to its export markets. So in that context, what are you looking at when it comes to the industry, both exports as well as domestic?
Yeah, I think it's a very good point. Let me break it up into domestic and global markets. Domestic market, I think the two-wheeler industry has been going through a bit of an upheaval. Particularly at the entry level, there has been a significant challenges. The 100cc and 125cc segments have significant headwinds that they have faced through the year. And I believe that will continue for some more time. So on the two-wheeler end, I think there is going to be a somewhat tepid year ahead. Whereas on the passenger vehicle, I think there continues to be a fairly robust growth. And there's going to be robust requirement even for the coming year, because there has been also good backlog of businesses. So between the two, I think it will be one a positive and one is somewhat negative. On the global front, yes, global markets are also having significant headwinds, particularly due to the interest rate hikes and the economic slowdown and the uncertainties. I mean, in Europe as well as in China, particularly recently, thanks to COVID and overall economic slowdown. There have been uncertainties, and we have been facing this along with our customers, that we have also noticed that the slowdown is happening worldwide. The only differentiating point for us is that, for us, it has not much of an effect simply because we are having a strong order position.
Okay, so, just two quick questions, if you can answer them very quickly. The group debt, I noticed, has seen a sharp rise. The debt has risen to 604 crores in December. You had just 300 crores of debt in March of last year. Any plans to bring it down?
I think that the differential of about 250 odd crores is purely an acquisition debt for the acquisition of LDC.
Okay.
If you look at our long-term debt, which is at about 300 crores, and our EBITDA today is about, I think, around 300 crores. We are on a debt to EBITDA of 1:1, which is very, very comfortable. I think our debt leveraging is very, very low compared to any industry standards. So it's of no concern there.
Okay, all right. We will leave it at that. We've run out of time, but we will speak to you very soon yet again. Thanks a lot for joining in and giving us a quick update on the business. Let's do one thing. Let's take a quick break. On the other side of the break, Ruchit Jain of 5paisa.com will join in with some trading strategies. Stay tuned.
Welcome back. Well, the Nifty Bank has made a smart recovery of almost 250 points, or rather 350 points from the lows. From the highs, we are seeing some sell-off, on both the Nifty Bank as well as the Nifty. As you can see, the Nifty also is now back below that 200-day moving average after clocking levels closer to that 17,400 mark just as we started the show. So we have seen some weakness at higher levels as well. Ruchit Jain of 5paisa.com joins us on the show once again. Ruchit, your thoughts on this recovery that we've seen in the Nifty Bank and the selling that we're seeing on the Nifty from the top every time it crosses that 200-day moving average after declining?
Yeah, very good afternoon, Mangala. Well, Mangala, I think there's no doubt that the short-term momentum still continues to be on the negative side for the overall markets, because if you look at the data, then the recent rising bond yields have put pressure not only on our markets, but the US markets as well as the European markets, which were trading around its all-time high and have now seen a negative crossover in their momentum readings as well. So internationally, we are likely to witness some kind of pressure going ahead in the European markets as well. And of course, if we look at our FIS data, they have started this series with too many short positions. Only 18% of their positions are on the long side at the start of this March series, and 82% are on the short side, with about 135,000 contracts on the short side. So this clearly indicates that in spite of the market's recent correction, their view is still bearish, at least for the first of the March series, which is likely to put more pressure on the markets going ahead. But only thing is that we have already seen some correction in last 7 trading sessions without any meaningful pullback move. Nifty has fallen by 800 points. Bank Nifty has fallen by about 2,300 points. So this has put the momentum readings of the intraday charts or hourly charts into quite oversold zone. So usually when we see that the data is negative but the readings are oversold, then we witness some pullback moves, and that sell on rise move continues after that pullback. So banking space, because the correction have been more on the Bank Nifty index, that's why we are witnessing this pullback more in the Bank Nifty. But the kind of the support levels that Nifty Midcap 100 index is also broken. So we don't think that broader markets would witness any recovery from here on. Broader market sell-off is likely to continue, but some of the banking space or some of the large cap banking stocks are likely to show some pullback move to relieve this oversold setups.
Okay. Rajit, just a two-part question. One, wanted your specific stocks of the day, and two, you've spoken about the financials, but I wanted to ask you about IT as an index as well as specific stocks within the IT index. Reason I ask is obviously it's been quite resilient as compared to the other indices. So specific stocks for today, your recommendation and the IT index.
Yeah, so first I'll start with my recommendations. So I'll give two recommendations in line with what I spoke about my view on the markets, that some banking space would see some pullback moves. So Axis Bank is one stock where technically some momentum has halted around its previous swing low. So the pullback move, we could see Axis Bank going towards 878, 880. So one can go long for just for a short-term trading for a pullback towards 880 in Axis Bank, keeping a stop loss below 838. And one would be a sell call in PVR. So in spite of this entire consolidation which we have seen off late, the stock has now breached its important support of that 1600 mark, which had about double or triple bottom previously. So since that support is broken with good volumes, the stock is likely to remain under pressure. One can go short with stop loss above 1590, expecting target somewhere around 1440 in the near term. Now coming on to the IT space, I think a lot of we have seen that in past also. Our IT stocks also witness trend accordingly to what's going in the Nasdaq index. So I think still the global markets remain under pressure. IT space is also likely to continue to show underperformance. I think within the IT space, Tech Mahindra would be only name where I would recommend some buying on declines, because the off late we have seen some good price volume action there. But I would be a bit cautious on the IT names over here as well until we see a recovery in the global markets again.
Okay, all right. Thanks a lot for joining in, Ruchit. Have a good day. Let's slip into a short break. On the other side of the break, there are a lot of big investments taking place from the private equity side. We have Renuka Ramnath, the founder, MD and CEO at Multiples Alternate Asset Management, to discuss in detail on their...
Welcome back to the show, and let's focus on the deal street. Well, Renuka Ramnath, who's the founder, MD and CEO of Multiples Alternate Asset Management, joins us now, and her private equity firm has announced an infusion of about 1,200 crore rupees in electric three-wheeler maker TI Clean Mobility. Renuka, always a pleasure to welcome you on CNBC-TV18. Now, this particular company is a wholly owned subsidiary of the listed company Tube Investments. Can you share more details about the 1,200 crore investment, and what is the valuation of this company as per your transaction?
So, Tube Investments is setting up a subsidiary called Clean Mobility for building a set of commercial vehicles. It has three-wheelers, it'll have heavy commercial vehicles, it'll have tractors, and Multiples investment is into this company, which is a subsidiary of TI. And the total fundraise in this subsidiary of TI is a 3,000 crore fundraise, of which Multiples will be investing through its partners, along with its partners, about 1,200 crores. Another 1,000 plus crores will be raised from other investors. And TI themselves, as the parent of this company, will be infusing 750 crores. So it's a 3,000 crore fundraise in this company.
Okay. Renuka, good afternoon. This is Sonia here. this, of course, is one transaction, right? But I want to understand what the rationale is of multiples to invest in the electric vehicle space. How do you see the evolution of this entire infrastructure? I ask because there are still several pieces that need to fit into the puzzle, whether it's the charging infrastructure, whether it's range anxiety. These things have not been ironed out just yet. Do you think it's going to take a long time for some of these businesses to evolve and grow? And apart from this, anything else in this entire piece that multiples would be interested in?
Yeah. So, Sonia, if you really look at multiples story right from inception, we have focused on how do we identify the big shifts in the economy and appropriate the growth and value creation by entering these spaces at the time when the proof of concept is already established and you ride the growth. We have been early movers, but we are not angel or first stage investors. So we have been catching these big shifts at the inflection point. We did this with delivery way back in 2013 when e-commerce was the big thing that the economy was witnessing. We have done that with Quantify for AI ML. We have done that with MoEngage for SaaS. We have done that with Acco for fintech, and quite a number of examples I can give you. We did that with Dream11 when fantasy sport, riding on the back of huge digital penetration and the need for Indian consumers to have active involvement with the sport. So I would describe this as a DNA characteristic of multiples. We see a huge shift impending in the electric vehicle space. It's driven by our country's commitment to environment and also on-ground adoption. So just to tell you, in 2022 alone, we have seen 1 million vehicles, electric vehicles already sold in this country.
Right. Right. So you are seeing that adoption grow, and that's why your interest. But multiples has always been more cautious in their approach on investments also. Renuka, like when you invested in delivery, the other direct e-commerce players were available, but you wanted to take a more safe approach. That's why I want to ask you again, what is the potential of this particular investment in terms of growth and utilizing the funds that have been infused right now? What is the potential that you see of expansion in the next few years? And how do you see this particular business grow? And also the valuation bit, because it is a subsidiary, wholly owned subsidiary right now of a listed company. So how much stake goes out and what is the valuation at which the deal and the investment has been done?
Yeah. So one, both by way of our government's commitment to, managing the environment on a global level. And therefore, a whole lot of steps that have been taken to accelerate through FAME initiatives and many other initiatives to embrace the change from fuel vehicles into electric vehicles is a very, very obvious kind of a macro. Within that, what to play is a choice that multiples has, and when to play and with whom to play, right? We have made a conscious choice that we will go through the commercial vehicle route to appropriate value from this electrification of vehicles. We have also made a choice that we will not go with an existing OEM. We are going with a very reputed group who have exemplary manufacturing capability, great engineering capability, but they are not an OEM. They have their strengths in manufacturing and they have their strengths in financing. We feel that both these are excellent ingredients to build a company without any disadvantage of being in a legacy business. And number three, we have backed Velen to go and build this company. It's a partnership that we have enjoyed and benefited in the past. So we know his particular style, and we believe that we can be an excellent partner for Velen to go out and build this company. So it's a combination of great macro, great group with skills,
Yes.
no legacy disadvantage, and an excellent entrepreneur on the ground.
All right, you enumerated the rationale for this particular investment, but you are taking the EV investment route through the commercial vehicle segment. That's a big takeaway as well. Thank you so much, Renuka, for joining us right here on CNBC-TV18. Thank you. And with that, we'll slip into a quick break on the show. On the other side, Manisha Gupta joins us with Jonathan Barrett of...
Welcome back, and joining us on the show now is Jonathan Barrett of Probus Securities. Jonathan, hi, good to have you. And what a complete sell-off is what we are witnessing in case of gold and silver, both these commodities, with gold down 1.5% on week and silver fell 5% in the previous week there. We do understand that the dollar index is trading at a 7-week highs, and that definitely is putting pressure on the markets. But the kind of sell-off that we've seen in both of these precious metal prices, is there a buying opportunity at all, or the kind of scenario that we are in, would you suggest further declines?
Oh, look, you know what? Has been an aggressive move. There's no doubt about it. A lot of it is all about US dollar. We still have those inflationary feelers out there, which I think will help gold sort of stay up from these prices. And I really don't like the US dollar trading too much stronger from here. So I've got to be a cautious buy for both of them, particularly silver, because silver has been shellacked. There's no doubt about it. But I do think that we still have this inflationary feel. That PCE index came out, you know, the recessionary, the more unstable, financial stability starting to come through. So, yeah, I tend to think that once we get that exhaustive move to the downside, the gold and silver, you should slowly start to come into it again.
But before that, do you see gold prices below, breaking below $1,800? Do you see 20.5 giveaway in silver? Where are you looking at supports now?
I think you're right on it. I think when you look at it, I had a target around about that 1810, 1800. I didn't really want to see it go below that level because that is an important level for support. I get a sense that the market does want to take it through that area. But if I get an aggressive move back to the top side, which cements that low in place, then I'd be comfortably starting to buy, knowing that I have a stop. But we have seen that continual decline. It has been on the back of numbers. It has been on the back of the US dollar strength. So I would actually like to see an exhaustive move to the downside before I actually come in. And a similar level there on silver. I think we are right at those points there, which we really want to see hold, just so we can continue with this bull phase, which we've all looked at over the last 6 to 8 months.
Jonathan, history has shown that gold and silver prices do decline when you see the rate hikes begin, and by the time we are at the peak as well. But once it starts going down is when the gold and silver prices start to raise. We still are looking at inflation concerns. We still are looking at Fed winding down its purchase book from 9 trillion to 8.35 is the last number that I saw there. So by the end of this year, what would you be watching out for? What is your sense on where the gold silver will end this year now?
Look, I'm still in that phase where I think gold will continue to trade higher. There's still a lot of buyers out there, particularly the central banks, and they're continuing to accumulate a lot of gold. And I think as we still maintain concerns, in the Middle East, in the Ukraine, with Russia, I think that we still have to have that element of movement towards gold. I think gold, or I continue to think that gold will retest those highs up around that 1950. It wasn't only about a couple of weeks ago that we suggested that it could get back to those levels. It came very close to 1950 and then came right off it. So I would like to get a test of the highs again. Let's see how it travels. But at the moment, certainly the bears are having their way.
Jonathan, a word on the base metals as well, because while we still are looking at weaker data from US and Europe rather, US has been very strong data, but the China reopening trade perhaps is already panned out now. With the kind of sell-off that we saw in the month of Feb after that very strong gain for Jan, how is March looking to you?
Oh, look, you know what? I think when we do see that China story, when we look at, the likes of copper, when we look at aluminium, I tend to like copper, and I have liked copper for such a long time. It has had a good move. I still recommend it's a buy on dip. We are going to have shortages, particularly when China sort of starts to reopen. And also note that we're coming out of winter. So I would expect as we come into, that spring and that summer period, if we get around some of the air pollution issues, but we will generally see more demand come to the market. We have seen that in iron ore as well, but at the moment we're just seeing a bit of correction. But as I suggested, I think copper still remains a standout for 2023, because I do think we're going to come into some major shortages there in supply. And whilst we'll see China continue to be supported by government intervention and all those other things, I think we'll still be in short supply. So still like copper on a dip if you do get that, but looking for good things in 2023.
Okay, all right, Manisha as well as Jonathan, always a pleasure hearing your views. Thank you very much for joining in and taking us through the commodities outlook. We need to take a short break, but we'll get you more on the markets. Full tilt back on equities once we're back. Stay tuned. Welcome back. Well, it is a tough day for the Nifty and there are a lot of frontline stocks which are in focus. Dr. Reddy's is one of them that we are tracking. That is because they have announced an acquisition worth around $90 to $100 million. They will be buying Australia-based Main Pharma's US generic prescription portfolio for that amount. Now, the portfolio includes approximately 85 generic products, which includes 45 commercial products and 40 non-marketed products. It includes a number of products for women's health. The total revenue portfolio in terms of revenue was around $111 million. Now, there are some high-value products, according to analysts, for example, a hormonal vaginal ring, birth control pill, a cardiovascular product, and there are key drugs which are still not a part of the portfolio, but is expected to be worth around $250 to $300 million in terms of market size. It will be an upfront cash payment of approximately $90 million, contingent payments of around $15 million. The stock is lower possibly because the street is anticipating price erosion in the US generics market. It is estimated at around 10%. But on the flip side, people believe that maybe price erosion is also bottoming out in the US market. So this is a good time to enter the US generics market in terms of a larger portfolio. North America is around 45% of total sales for Dr. Reddy's. So yet, let's see how this particular portfolio pans out. Valuations look reasonable at around 1 times price to sales is what they've paid for this particular acquisition. Well, on that note, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.